back to Wealth Dynasty. Super excited about this episode. We have today Michael O'Connor, and we're actually on location in Grand Cayman here at the Fig Tree office in Grand Cayman. And Mike's been good enough to set some time apart to get on the podcast with us. Mike is one of our top investment advisors, and he's got multiple clients across multiple countries, and he does, structuring, but also, his investing. We're going to kind of go into what he does, what his strategies are, and how he helps people grow their wealth. So super excited to have you today. So Mike, tell me about yourself a little bit.
Yeah, so you kind of touched on it there. I'm based out of Grand Cayman, so I set up and run the Fig Tree Cayman arm, essentially. So for me, I wear many hats, but I guess from a Fig Tree element, like really what we're doing is helping people structure, protect, and grow their wealth over time and manage all the complexities that come with that. For me, I very much come from a background of trading, investment, etc. So that's my bread and butter. That's where I'm most comfortable. But really, it can be any problem that we're helping clients with. That can be tax structuring, that can be real estate, that can be banking, that can be estate planning, whatever it is. So the primary conversation typically can start on the investment side, clients coming in looking to create a structure that helps their wealth grow over time. So for example, our Fig Tree growth model at the moment, which is our kind of model investment portfolio, is up 16% year to date. That'll be broken down into 60% equities, 20% fixed income, 20% alternatives. And that kind of gives you an idea around how we're kind of investing our assets, but really it's going to be a different situation for every single client. So I'll have clients that have quasi-treasury accounts with us. Really clients who are coming saying, I have money in the bank making zero return. I have cash burning a hole in my pocket, whatever it is.
Money.
Yeah. And they're saying, I'm looking to buy a house in 2 years' time, but I need to make some return in the process. For us, then it's about structuring something that is generating decent return without bringing any price volatility into that as well, because they just can't, because of the timeline, take any volatility exposure there. Okay, so we're structuring our portfolio that's, say, earning them 4 to 5% at a kind of risk-free level that allows them to at least kind of have the peace of mind to know they're not losing value versus the inflation rate over time as well. So that's kind of one side of the risk spectrum when we're structuring for clients. On the other side, you have your more growth mandates that we put in place. So for some clients, I'll have what we call speculative growth mandates, which essentially is us taking high growth, high beta exposure to concentrated stocks within the market. So typically one of these portfolios would look like 10 specific stocks that have higher beta and are exposed to long-term secular trends that will benefit over time. For certain clients, that's perfect because, for example, for one client, we've structured that for them in that way because the portfolio is for their grandkids in 25 years' time. So that short to medium term price volatility isn't their priority. The long-term growth of the portfolio is the long-term priority. So that portfolio, for example, is up 98% in 2.5 years. So that does fantastically well from a growth standpoint, but there's a lot of volatility that comes into that some people can't stomach. And for example, in April of this year, that portfolio was down 22% when the tariff situation was going on. So all of this needs to be considered, and that's just kind of give you an idea of both sides of the spectrum. Typically, a client will sit somewhere in the middle, but it's up to us to kind of find exactly where they sit based on exactly what they need, their time horizon, their risk tolerance, etc. And then we'll build out that portfolio specific to them. So that's kind of a lot of what we do on the investment side, but obviously there's kind of much more to it.
There's a lot more to it. Yeah, that's good. And what are some crazy examples of maybe crazy stories with clients, or if you had some stuff that's just been weird requests?
I guess a lot of it tends to be, I think there's a preconceived idea that wealth management or portfolio managers, from our standpoint, like us, are just doing the investment management, just doing stock selection, just figuring out where exactly our money goes. That's a big part of it, but a huge part of it as well is being a trusted advisor for everything else that comes in, every other financial problem that comes in. So like with a lot of money comes a ton of complexity around tax structure and jurisdictional bases everything, especially when some of our clients are running large operational businesses as well.
Internationally also,
yeah,
yeah, like multiple jurisdictions.
most of our clients will be globally exposed, multi-currency, have big operating business, and really it's less on the investment side, but more on the trusted advisor side, where we come in and be the CFO or the trusted advisor who project manages all of the financial problems they have, not only on the investment side, but also on the structuring side. That's where the kind of interesting stories lie for me. That's the kind of where the crazy stuff comes in. So you're dealing with families who are trying to pass an operating business from one generation to the next, and the difficulties that come with that and helping to navigate that. That can lead to some interesting conversations along the way, because a lot of time clients try and do a lot of this stuff too late. So it's not really preventative planning. So what ends up happening is there is not a structure put in place that allows for the kind of streamline of one generation to the next. There's not years of training and mapping done out for how a successor will come in from a family business standpoint. So a lot of the time we can be brought in when the situation has become quite difficult, and we come in to try and resolve a lot of that.
What would you advise? Like, that's a good point there. Let's say somebody has a family business, they're when should they get their kids involved? When should they get, that takeover and the whole process started? I mean, obviously, you're saying don't wait until the last minute, because obviously that's a bad idea, but is there like a sweet spot, or what have you seen like the most successful clients do?
Everyone's different, but for me, it's really about bringing them in and letting them understand exactly what's happening as early as possible, if the true plan is for them to eventually start taking over this business, because everything is going to be learning for them. Everything is going to be a way for them to kind of grow their expertise over time, until such time as they're going to take on the responsibility. There's a lot of first born founders who are the first generation of that company, who have obviously created this baby that they love so much, and delegation for those people has never been their strong suit.
Yeah, they want to control everything.
But in reality, if you're going to have a legacy plan, you need to be able to think about delegating what you do over time to whoever you want to be stepping in and taking over in your place. Because otherwise, and we've seen it time and time again, that next generation are going to fall at the first hurdle, because they just haven't had the structure in place
The experience and the years.
have the so like you can do it in multiple ways from a structuring standpoint, in terms of you don't need your kids to come in and have voting rights over your business to start with. You can structure a family partnership so you still hold all the voting shares and the preferred shares, and then maybe the growth of the assets can accrue to your kids, but it allows you to keep control while getting the kids involved from a kind of an earlier standpoint. So for me, it would always be, if truly that is the plan, then you need to work on your delegation as much as possible to make sure that they're not just be giving something that is just going to end up being a huge burden on them down the line. So, in terms of legacy planning, these are all conversations that have to happen.
Yeah.
A lot of the time, there's founders who are structuring for exits, but they only ever think about the structure of the exit once the exit comes in front of them. When in reality, they should be structuring from a capital ownership standpoint, from a tax structuring standpoint, long before the decision to exit comes.
That's
So,
awesome.
they're all kind of conversations that we have with our clients. So typically, for us, it can start with, okay, I need to do something with my money. I need to grow my capital over time. And that's the initial conversation around the investment returns. But typically over time, we'll create strong partnerships with our clients, who we then function as their trusted advisor across all of their other financial problems. So a lot of the time, things that I would be doing in my day to day is project managing more complex problems that they have. It's still associated with the investment side of things, but it's good for them to have a project manager who understands exactly what they're trying to build and all of the various elements of their finances and business. So we can lean on our network. So I have clients, for example, who need tax advice out of London, trust advice out of Jersey, and then fund admin banking out of Cayman. But in order for them to fully bring that entire picture together, they need someone to kind of lean on our network to be able to pull in various either trusts or legal or tax professionals from each jurisdiction, and then we'll sit on top and make sure that the exact structure they need gets put in place. Because for a lot of clients, they don't know what they don't know on that side of things.
Correct.
So you have to be that expert who's built stuff like this multiple times before to be able to come in and say, yes, okay,
Yeah, we've done
this is how it should be
the
done.
best way. Yeah,
Yeah.
this is the best practice, and this is what everybody else has done. But you could do it this way, or you could do it this way. Here's some options, but that's super important. I love how you I guess you see yourself as like a personal CFO of the organization that you're working with or the individual you're working with, because then you can and you really dig down into getting to know every angle of their business and every their goals, their family even. That's super important, because if you don't know all those different angles, you're not going to be able to really properly structure and get them to their goals that they're reaching for.
Yeah, it can't just be simple wealth management anymore. It can't be simple just your investments go here. If anyone who's had any experience with significant amounts of wealth understands that there's so many problems that come with this. And yes, they may be first world problems, but there are problems all the same in terms of structuring these things. That can be understanding how you pass on assets to your kids. So for me and for a lot of my clients, a lot of what they're trying to achieve is it's a kind of famous thing on the kind of Warren Buffett side is give your kids enough for it so they can do anything, but not so much that they can do nothing. So it is making sure that you have structured a plan for your wealth and how it gets, passed down to your kids over time and what that will mean to them. So you're looking at maybe trust structuring to protect their assets, but also a lot of that can come down to how you set out a letter of wishes for your beneficiaries to make sure that everything you provide for them doesn't negatively impact them as well.
Correct.
So
I have a lot of friends, I mean, very wealthy billionaires and millionaires and multimillionaires that their kids, exactly like you're talking about, their kids become pretty much disabled or become, go down some pretty dark paths because they have everything and they don't need anything. There's no struggle. There's no,
and I think it's easy for people to looking at that negatively, but in reality, if anyone took your purpose away in life, that would be a huge negative draw on how you approach your life. So it's really about making sure that you allow them to still have that purpose. That maybe for a lot of people, there is a kind of a tendency to have money as their de facto purpose. And if you take that away from someone and say, okay, now if that's not a problem, how do you structure your life from there? So you want to make sure from the trust standpoint that anything that you are structuring for your kids doesn't take away any of that purpose for them as well. So, again, this is just a kind of a long way of saying that the variety of the problems that we solve goes far beyond the investment. Yes, that's what I like to geek out on, but it does have to go far beyond that. I think at the broadest level, we're really just financial problem solvers. So our clients will come to us and we'll either A, be able to solve that problem, whether it's banking, investment related, trust related, tax related, structuring related. We'll either A, be able to solve it directly, or B, be able to lean on our network to make sure that we're able to help to get it resolved.
Yeah.
And that's really what it comes down to. And that's, I guess, why I love this job. I get to wear a lot of different hats, but also I love solving problems. And that's what it is, really.
That's amazing. I love it. And then as far as investing, like obviously there's a lot of different strategies, and that's going to be very dependent on what your clients are, their timeline, their all their structure and the net worth, because that's that, you're going to over allocate if you're not, in a certain place financially. So what, I guess, what's your strategy as far as investing is, because that's kind of like where you come from before you came into Fig Tree. So
your strategy will tend to deviate over time depending on what the kind of prevailing macro trends are. But I think at the very highest level, to keep it kind of as simple as possible. Okay, so over the last 5-6 years, we've seen $16 trillion being pumped into the system. We also have seen since 1990 public equities fall from 8,000 to 5,000. So in the most basic of terms, we have fewer and fewer assets being chased by more and more capital.
correct.
So asset price inflation should be no surprise to you. So there's a lot of talk around CPI and inflation, etc. But CPI is a very objective number, but really inflation for everyone is a very personal number. If you have just bought a house and the inflation rate skyrockets, it's probably beneficial for you because the
Your value
relative
just,
value
yeah.
of your debt is falling over time. if you're trying to be the one to get in and buy a house at the time and inflation spikes up and the price of the house you're trying to buy goes up massively,
Plus the
then
interest rate.
then that's a huge burden on you. So every person's kind of inflation is going to be different, right? And I think that, like, looking bluntly at the kind of CPI numbers, etc., and saying 2% is underweighting what the true inflation numbers are and what's really happening from an asset price inflation standpoint. So people think of inflation as your groceries going up, everything, but really the money has to flow somewhere, which has led to this asset price inflation. We're seeing gold, you've seen Bitcoin, you've seen equities, you've seen everything run, but that shouldn't be a surprise for you if you look at the mechanics of the system where there's more and more money being pumped into it. So a very broad way of looking at that is from a government financial, like kind of a fiscal policy standpoint. Obviously, there's a lot of talk from Besant, etc., of reducing the fiscal spending from 8% to 3%. But in reality, then you have the Big Beautiful Bill and 3.3 trillion more being pumped back into the system. So for me, it's kind of watch what they do, not watch what they say. I don't think there's much of a political will to run fiscal surpluses over time. We're very much pushed into the fiscal deficit over the long term, in my view. And therefore, if the government's approach to this fiscal debt is to inflate away the debt, then own things and inflate with it. So at the most basic level, own things.
Yeah.
And don't be surprised when your cash loses more and more value over time, because that's exactly the structure that's in the system right now with the heavy fiscal system that we have and the heavy fiscal policies. So at the most broad level, that's the kind of macro trend that's there at the moment. Obviously, there's a lot more that has to be kind of looked at that from a kind of momentary standpoint. So for our fixed income exposure at the moment, we're not trying to be interest rate predictors. So for us, that means coming way in the interest rate curve and really shortening duration of our portfolios. So really, we're looking at picking up higher yield based on the credit ratings of providers that we like, that we think are maybe unduly offering higher yields than maybe the relative market based on the coverage ratios and cash flows that these companies have. So we're looking to find companies that are producing decent coupons, that have solid credit ratings, instead of trying to predict what the interest rate will do on the 30-year or the 10-year. Because really for us, the fixed income portion of the portfolio should be the ballast of your portfolio. You're really just trying to create that 5, 6, 7, 8% income from that piece of the portfolio, and you're not trying to take a lot of price volatility exposure. If you're buying up 30-year bonds, the price exposure that can come from that is massive. So people talk about duration as the term of a bond, but in reality, duration just means the price change of a bond for a 1% change in interest rates. So if you have a bond that's 30-year duration and interest rates go up by 1%, the value of that bond will fall by 30%. So when you're thinking about your fixed income portfolio, you're not thinking about potential 30% swings. Really, that's not what you want. And you've seen over the last 5, 6 years, the interest rate just increase over time, which is meant the value of your bond portfolio has fallen over time.
30 years.
So really, if you want your bonds to protect and be that balance in the portfolio, for us, it's about staying short of duration curve at the moment until there's more value on the long end. So like, I think a lot of our philosophy comes around, there's kind of two things for me, is like, be risk on when markets are in a statistically defined uptrend, and be risk off when markets are in a statistically defined downtrend. So that's watching technical analysis to see where the momentum is lying at any one time. But on the other side of things, it's about looking at positive and negative asymmetry. So some people talk a lot about buy and hold investing, but like most things in human nature, I think we take it to the nth degree. Buy and hold doesn't mean that you buy something and never ever look at it ever again. I do agree that timing markets is a very, very difficult thing, but there is momentary times in markets where there is this in either positive or negative asymmetry. So something that would have negative asymmetry is just saying that there's more downside than upside.
Correct.
So if you look back at kind of 2020, 2021, when you had basically zero interest rate policies, your bonds were making zero. And as you just went through, bond prices will only rise as interest rates fall. So there was nowhere for the bond price to go from a positive perspective, they could only essentially turn negative. So this is like a completely negative asymmetry in bonds, but yet people are just holding bonds for the sake of holding bonds because of what they've always done.
Hold that back.
Yeah. So like, it's just one of those things that, like, for us, yes, on the investing side, it's very difficult to time the market, but there's clear and obvious indicators from a momentum standpoint and from a negative asymmetry standpoint to show, okay, this is not what you want to be in based on the current prevailing market trends. So for us all the time, it's about monitoring that to make sure
constantly
that
staying up to date on that. Yeah.
And I think a lot of the time people like think about jumping in and jumping out of the market. For us, it's more of a dial, or think of it as like putting gas on the pedal, taking gas off the pedal. So for us, just on our portfolio in recent weeks, we've made adjustments to some of the positions that for me have become quite stretched. So a company I love is C Limited. I love companies that are like high ROIC, high capex spend, strong moats, that have a lot of vertical integration across all of their businesses, so they can kind of basically sell one vertical and horizontally sell it across the board. So like
You're just multiplying.
Yeah, it's like that Amazon type structure. So like we all like McCarthy, Amazon, C Limited, they were all similar structures where they have a huge e-commerce business, but that then leads into gaming, finance, supplying everything. So I love those types of businesses, but at the moment, C Limited, just from a valuation standpoint, just got a bit disconnected based on the kind of pace of the run-up that it had. So it had given fantastic returns, but it also was just got a bit ahead in terms of its own fundamentals. So it was trading at kind of 85 times PE, which makes it very expensive, but it had, returned 100% over the last kind of year or so. But in the last few weeks, it's pulled back. So thankfully, we kind of reduced our position. It's pulled back since then. If that comes down to like 140 again, I'll be happy to kind of start buying up that position again. But it's always about kind of turning that dial and making sure that you're kind of watching everything that you can. But it's never about trying to kind of jump in and jump out. Like you saw during the Trump tariff situation in April, the thing that makes the investing so hard is that so many of the best days in the markets are clustered around the worst days.
Those worst days, yeah. I mean, if you look at those averages of after the worst day in the market, it's like 8 or 9, 10 days after that, you have like, record highs, or, almost get back to the level it was. A lot of times I've seen, in the data, it's just like, it's incredible, that growth right afterwards,
Yeah. So like,
15 days out.
I like to watch the patterns of drawdowns. It's not to kind of geek out on it too much, but typically the velocity of the downtrend would match the velocity of the uptrend. So essentially, if you see this huge wash, a lot of the time it can be kind of a liquidity washout. But what is happening is essentially you want to match if you see the slow precipitous decline in markets, typically you'll see a slow precipitous uptrend. Whereas if you see this large washout like we saw in April, for us, that's buying opportunity. That is, okay, time to now assess all of the things that were on our watch list in terms of positions that we can move into
At the right price.
And it's always about just being prepared for those situations. Because for us, we'll watch the pace of the velocity of the drawdown, wait till, we see some numbers on the RSI side and MFI side, or the technical indicators, essentially to say, okay, we feel these are overbought here and there's starting to be some reversal trend in the market. And then we're looking to kind of place our money. It's not about catching the exact bottom. Personally, I find that very difficult. Typically, I'll wait for a higher low to set in before we're kind of buying into those positions. But it's about constantly monitoring those so you're kind of prepared and able to kind of take the opportunities as they come. But yeah, I guess like that's a lot of what our investment philosophy stems around. Like I remember in April again, I think there was 3 negative 5% drawdown days, and then there was that Tuesday where the Nasdaq was up 11.5%.
It was incredible.
If you're that guy who pulled out your money on that Friday evening, that's an unbelievably difficult thing to swallow, and it's unbelievably difficult to get back in after that 11.5% has already been given
Emotional
back.
roller coaster.
It is, and it's just a really difficult thing. And so you need to be able to kind of turn that dial. And I think sometimes we can try and get too smart when it comes to markets. Like if you look at the trend that's in markets at the moment, the winning strategy for this year is buying companies that are pre-earnings. So basically pre-revenue. So basically making companies that are losing more money than they're making.
Yeah.
That was what has outperformed this year. So to say the investing is easy or say it's obvious, it never is. So there's always going to be
Constantly.
yeah, there's always going to be trends that are difficult to pick up on. Really, it's about taking broad exposures to companies that you have high conviction on and being ready when those companies go on sale, essentially, and kind of doing that repeatedly over time. I think, if you can continue to research and stay informed, the probability of success over the long term becomes, infinitely higher. And it's not about any kind of 1 month period or 3 month period. Really it's about accumulating large amounts of capital over time. So I see friends of mine even who kind of trade accounts, etc. And, they might make, I was talking to a friend of mine yesterday who was doing zero DTE options, so zero date options. So huge volatility on these names, but he made 12x on a Google option that he had in place, right? Obviously huge money, huge returns but he's playing small amounts of money. So really it's, you make a lot of money on a couple $100, whatever. For me, it's about building out safe structures that you're willing to have hundreds of thousands, millions of dollars
Millions
in
of dollars,
place.
yeah, because you're managing millions.
Yeah, and that's
And that's
where
not something to be playing those little games with.
yeah, and that's where the compounding really happens. So 10% on $10 million is far more effective than 12x on your 500, obviously, So like really that's where the kind of game starts to change for a lot of clients. We'll help them figure out what their kind of distribution needs are in retirement or when they want to step away. So if that's, say, 300,000 they want every single year after they retire to help fund their lifestyle, if it's for us to then figure out what number we need to get to in terms of whether that be 10 million, 5 million, to have them in a situation where they're able to
not touch the capital and just live off that interest and pay their fees.
And then we can adjust the risk on that portfolio so that we're in a situation where there's that wealth accumulation phase where you're contributing to the portfolio and you have growth exposure to get to that number. And then after that, you can kind of de-risk the portfolio somewhat. So you have less price volatility, but you know that the distribution from the portfolio is only 3% of your portfolio and the portfolio is kind of steadily making 6% a year and growing over time. Like at the end of the day, investing is just math.
Correct.
So like at a certain point, there is math that just works for you. And it's about us helping you find that figure and then growing the portfolio to get to that figure. So you're kind of in a good place over time.
That's awesome. Now, why would a client, I mean, obviously you're here in Grand Cayman and there's lots of tax advantages for, a lot of those clients that either will start a business or a trust or some structure here locally. Why? We've got a lot of international viewers. Why would they want to talk to you here specifically as opposed to anywhere else in the Caribbean or in the United States, for example? What's the advantage?
Yeah, so a lot of it comes down to clients who are structuring here for business purposes, or, if they're moving down here, then all of a sudden you have a fantastic way of life, great proximity to the US, but also you have zero personal income tax. And obviously that's a huge benefit for those looking for large exits or whatever it is. We can kind of help to structure that as well. But ultimately that is a big part of it as well, and just helping them to, from a jurisdictional standpoint, manage that move and that structural change so that they're able to kind of mitigate that from a tax standpoint as well. So typically we'll kind of help clients on that side, and then we'll kind of structure out their investment portfolio from that
through their whole financial situation.
Yeah, and the investment management is so much easier when the tax considerations are so much more reasonable here. Like I'm Irish originally, and not to go too into it, but the investment side in Ireland is a disaster zone in my view. So like it's basically not built on meritocracy in terms of what the best investment is. It's built on what is the most efficient tax mechanism for you. So it is really a kind of poor system in place. So, with the likes of Cayman, etc., it's really just about, once you have made your money, you then are able to let your money work and grow for you without having a lot of those kind of tax complications that come with that as well. So yeah, that's kind of a lot of
what we do here as well. That's huge. I mean, there's a lot of people selling a business, or they're just trying to find somewhere to shelter, both, tax wise, but also, there's tons of benefits.
Yeah,
that's awesome.
Yeah, and I think for a lot of our clients, they're global citizens. We see it more and more all the time now. So for some of them, it's just having a base that is central to the US, etc., but is kind of perfect for them and what they need in terms of pace of life and everything. And the tax side is simply a bonus, but you need to be resident here and kind of committed here in order to benefit from the tax side of things as well. So
Good. Now, another question. So let's say we have a customer comes to you. Is there like a limit where, do you have like you need to have at least 100,000 or what, like 500,000, or what's kind of like where do you specifically start out as opposed to other advisors?
yeah, for me, like I'll probably advise.
That's a tough question
Yeah.
because there may be, because you really have to dig into people's situations. There may be like a family member that has more that you could, there's a lot of
I think
out
that
there,
is
but
a lot of
yeah.
it. So like at the moment, I have typically the minimums would be 500,000, but I do have clients below that because they are growing their portfolio all over time.
Yeah.
And based on their kind of perceived earnings in the future, etc., will kind of be able to grow that account over time.
Yeah.
And I'll be able to kind of grow with them as they're growing as well. So
Incredible. Yeah.
for that, for me, that's how I'd structure it, because the Cayman entity for Fig Tree is less than a year old. So for me, it's about gathering that client base that are happy to kind of grow with me over time.
Yeah. Grow with the office. I mean,
Yeah. So that's a big part of it. For other advisors, it can be higher amounts when in Fig Tree, but for me, that's typically kind of where we'd start the conversation of either at kind of that 500K to $1 million, or working a path to getting there.
yeah. If I could just landed a role as a director or CEO, and I'm making, $500,000 a year, and I only need to live up 100, so take 400.
Yeah. So like, for example, a lot of my clients will have huge earnings, but for the last, say, 10 years of that earnings, they've been buying properties, they have been setting aside heavily in pensions, they've been investing elsewhere. So they've kind of bought all of their large investments that they need for their life up front, from having, like, say, house in the UK, maybe a house here, a house in the US, whatever it is, and various other elements. And now they've coming to say, okay, this is where I'm thinking about this pension part of things, where I want to build out my own pension book here, so that in 10 years time I'm able to step away from what I'm doing. And then that portfolio becomes a portfolio with very large contributions for the next 10 years, for example. And we're kind of helping them build and make sure that the investment growth is strong within those portfolios, but the contributions are strong as well, because like really a heavy lifting at the start of any portfolio is done by the amount of contributions you're willing to make.
Truly. Yeah, that's great. Now, where do you see the life insurance and with your clients, like where can life insurance fit into their, obviously, you have this holistic approach where you look at every single angle. Where does that life insurance fit, and where are some, I guess, situations where you think, or seen that people could or use life insurance?
Yeah, so for my clients specifically, a lot of what I see is households with very strong single incomes, which then leaves the household exposed from a kind of key man risk, essentially,
Sure,
to the household.
yeah, that's vulnerable.
If something happens to them, then their family kids are left in a precarious situation, especially for the type that I just mentioned, where they're now just starting to build up their base of liquid assets for retirement. So for them, the life insurance portion is very, very important, because to live in Cayman, to exist in Cayman, is not a cheap thing. So you don't want to be in a situation where, obviously, the plan A is that we live forever and everything is fine, but plan B, in terms of protecting your family, etc., that's a really important part of it, especially when you see those single income families that are exposed to one very large income. And if anything was to happen to that, then the entire discussion, or the entire kind of protection of the family, comes into kind of disrepute nearly. So really, I think that's where, at the most straightforward level, I see this as a kind of, not only like a nice to have, but a necessity for them.
Absolute must. Yeah. Like, I mean, let's say that, your guy with a 10 or 20 year plan, that insurance is going to cover them if from day one, you automatically have that number that you guys have already talked about, that 10 million, that 15 million that's already there. If anything happens, then the family can still live. You can still get your goals. Your kids can go to school at the school you want. You can have that trust and all those, everything all set up exactly how you like it. So I think it's a very powerful tool, and I think it's overlooked a lot of times. I don't know if you've seen this, but
Yeah, I think, is it just human nature that like we consider ourselves invincible, so debt becomes less of the conversation? Like I see with clients all the time. There's clients I know with large families, there's no will in place. There's, these are all things we know we need to do. But for whatever reason, there's inertia or something within us that says, I'll sort that out tomorrow.
We'll do it later.
We're all burdened with tons of problems. Unfortunately, that list of things we need to do never empties out. There's always stuff that kind of supersedes some of that kind of will and insurance standpoint that people, for whatever reason, tend to just put this stuff down to the bottom of the list. And it's for us then to make sure that clients prioritize that, because otherwise you're left in a situation where, unintentionally your family is completely exposed.
This whole plan is not going to work unless it all works together, essentially. So that's great. Awesome stuff. Thanks again for tuning in today. That was an awesome podcast, an awesome conversation with Michael O'Connor. He's one of our top advisors over here at Fig Tree, and he's actually manages and runs the Cayman Islands office for Fig Tree. And yeah, great information there. Talked about how he, his holistic approach with clients and how he, sets up different structures and his investment strategies. So awesome information. Thanks again, Mike, for your time. And if you guys need any information or you want to learn more information, go to our website. All the links are in the description. And Mike, we got your social medias. You got social medias? Okay, well, we'll get Mike's social medias all into the description. And these also on our website, figtreegroup.com. You can, find out for more information or book a consultation with him directly through the website. So thanks again for being with us. We'll see you next time.